Good morning, good afternoon, and good evening to all of you joining from all over the world today. I want to welcome you to our uh, webinar today, focused on Lessor Accounting. I think this is going to be a really interesting subject for all of you out there because we spent a lot of time in the past talking about lessee accounting and the impacts of IFRS 16 and ASC 842. But what we're beginning to see is an evolution in lessor accounting. So I'm excited to talk to you about this subject along with our team. Just to remind everybody, we are recording the webinar, so feel free to check that out later on. Ask questions throughout the session. There's a panel down there. I'm sure it continues to add value or add upgrades, so the panel might not look exactly like this, but you will have an opportunity to ask questions in a panel. And we'll answer all of those questions, or if we don't get time to, we'll certainly address those one-on-one with you later on. Again, we have a lot of previous webinars around topics such as Treasury, RevRec, and leasing. So feel free to go on to the website and download that. And speaking of that, feel free to reach out to us, contact us. We'd be excited to have you do that and have a dialogue with us. You can go to the website, as I mentioned, bramasol.com. We have a Facebook page, YouTube, LinkedIn, so feel free to contribute there. And then via Apple iTunes and iHeartRadio, I encourage you to go check out our podcasts. We have some great podcasts from Julio and from some of the other speakers that we've had in the past, and I encourage you to go check those out, subscribe to them. We put out a new one every month or so on topics that we hope you'll find interesting, so check those out. With that in mind, let's dive into the topic and what's our agenda. We're going to structure this. We have a demo today. Relax, have a cup of coffee, and enjoy. I wanted to welcome everybody. Again, welcome to all of you who've joined us in these challenging times. I hope you're staying safe, and we hope this topic, you enjoy it. Let me introduce for a moment our panelists. Good morning, Sarah. Thank you for joining us after your lengthy journey. I guess of over 40 hours. We are so excited to have you here. Hello, Sarah.
Thanks, John. Happy to be here.
And as always, welcome to Julio. He's been on many of our webinars and our topic areas. So Julio, thank you for taking the time out of your day and focusing on this topic. So welcome.
Glad to be here, John.
And we're hoping to get Sharish back. Hopefully he'll be able to join us. He's one of the members of our COE team and can ask and answer some questions about some specific areas around this topic. So Sharish, hopefully we'll get you back on. I know a lot of people are struggling these days with some of the internet challenges we have. Excuse me. Today we're going to talk about a few major subjects. Number one, I'll tee up a little bit of why we're here in a moment. And then we'll do an overview of Lessor Accounting, and Julio will lead that discussion, along with, we'll talk about that connection to revenue accounting. And then Sarah will be taking us through, together with Julio, a couple of different scenarios of OTL, so operating type leases, and sales type or finance type leases, and talk about why that's important to you and how you can get an integrated solution from Bramasol and SAP. And then we'll wrap it up with some Q&A, so feel free to ask again throughout, but if you want to hold your questions to the end, feel free to do that, or feel free to ask questions again at the end. So Julio, why are we here? We talked early on when we started this whole lessee process several years ago about the impact of ASC 842. And the fact that it was going to add what was estimated to be between $3 and $4 trillion of assets to people's balance sheets, that we were expecting to have a lot more information on what was going to evolve. And some people were predicting this was the decline of leasing. And actually what we're seeing, I think, is this new economy we're in, where people are looking more for solution and subscription models that leasing's really taking off, and in particular, this idea of lessor accounting, and how do you deal with that as companies are moving more to models where they want to lease, and companies want to move into these models that are more lease effective. So what does that mean from an ASC 606 and 842 perspective?
Yes, thank you, John. So as we know, in the last 5 years, we've had, in the accounting world, we've had a number of changes with revenue accounting and lease accounting. I think what a lot of people do not realize, unless you're actually in that business process that involves the two standards, they are pretty much segregated, but not so. For lessor accounting, if you think about lessor accounting is revenue accounting for lessors. So from our perspective, we see the two as very much intertwined. But to just give a recap on what has been going on in as far as compliance with the standards, most companies, public and private companies, have already complied with ASC 606, IFRS 15 from a revenue recognition perspective. What we see, though, is while there has been compliance, many people have complied via spreadsheets, via underperforming software, I'll call it. So there's a number of opportunities for automation and process improvement. There is one point that is people have not been adopted ASC 606 yet. Because of COVID, the FASB actually deferred anybody who has not adopted the standard as of today, which is not many. The big group of people who have not adopted is what we call the franchisors, people who actually have franchises and they have this franchise accounting, and they have been the lone large group that have been deferred for 1 more year. Moving to ASC 842, we have a number of most people have focused on the lessee side of the accounting, which is basically the capitalization of previously off-balance sheet transactions. Public companies have already complied, and this year, also because of COVID, we have seen the FASB has delayed private company adoption. So private companies have 1 more year, end of next year, 2021, to comply. So there's a number of companies, and based on our research and talking to customers, many private companies have not even started their efforts to adopt 842. On the lessor side, we know that even though there was a new 842 IFRS 16 standard, there has been little change to the accounting. There are some changes, but very minor when it comes to lessor accounting. So lessor accounting, the big change is what you see at the bottom of the screen, John, which is key aspects of lessor accounting guidance have been aligned with the guidance in the new revenue recognition standard. John?
Right, and I think that's crucial, Julio, and I think both topics have moved away from very strict standards and very strict requirements as they define specifically what is in these topics, whether it's the RevRec topic or the leasing topic, to a more principles-based model. And we're seeing a lot of companies also working through what they originally thought they were going to do and thought how that would work, to an evolution of the interpretation of that and the specifics around the actual execution of that. So
correct.
Yeah. So talk a little bit more about that lessor accounting and the 842, if you would.
Yes. So just a quick recap on the 842 lessor accounting side of the fence. So as we said previously, not many changes for lessors as there were for lessees. For lessees, it was a complete overhaul of lessee accounting for lessees, which meant that, if you had a lease before 842, you simply would record the expense and pay the payment every month. It was basically what we call the off-balance sheet financing transaction. However, the reason for 842, if you think about it, is that if I have a 10-year lease and I'm paying $100 a month, is that really off-balance sheet? Should it be off-balance sheet? Because I have a 10-year commitment. So the request from the FASB and investors the funny thing about investors, when they were looking for companies that are publicly traded, they were already building in this 10-year commitment already in their finance models. So this was sort of a evolution from the side of looking at a lessor accounting lease is whether the lease transfers all the risk and rewards incidental to ownership of the underlying asset. This brings us into whether, from a lessor perspective, you're going to have a sales type lease, a direct financing lease, or an operating lease. Basically, if you think about it, there are four main criteria that you talk about when you think about for a lessor. Is this a sales or direct financing lease, or is it an operating lease? The key difference really is in a finance sales type lease, the lessor essentially sells the lease, sells the instrument or the tool or the asset to the lessee. In an operating lease for a lessor, the lessor retains ownership. There's a lot of implications of that.
Sure.
If I have a lessor, it means that I have to depreciate the asset because it stays on my books. If I am a lessor on the finance side, I effectively sell that asset on day one, so I have a revenue transaction. So that is the main differences between the two. And the disclosures and financial statements really have not changed, but this is a good example. I wanted to bring this in, John, just to kind of give a graphic of what exactly does that mean. So if we look on this spreadsheet on the deck here, on the top side we have a sales type and direct financing lease. So as we talked about, from the balance sheet perspective, we're going to recognize the investment in the lease. So what does that mean? If I have an asset, I'm going to de-recognize the asset. So I'm going to remove it from my books. In return, I'm going to create this investment in lease, which is basically a long-term receivable. From the income statement, what does that mean? It means that when I de-recognize the asset, I am basically going to create a selling transaction. I'm going to recognize revenue, recognize my cost of goods sold, and take that asset off of my books. When I do that, and I create this investment in the lease, which is basically a long-term receivable, I'm going to recognize in my P&L interest income over that term of the lease. And then for my cash flow, I'm going to basically cash received from that lease is going to be classified as an operating cash flow. If I, on the flip side, for an operating lease, from the balance sheet perspective, I'm going to continue to recognize the underlying asset on my books, the lessor, which means that I now have to recognize depreciation on that asset. From the income statement for an operating lease is I'm going to recognize lease income revenue on a straight line basis over the lease term. And then again, from a cash flow statement, the cash received is going to be recognized as operating cash flow.
Exactly. And that's what was interesting to me, Julio, as you and I have worked through several different opportunities with many different companies here, looking at that specific aspect and the determination of a couple of things, right? And you and I talked about this earlier, which was, what's the real difference between the two? And ostensibly, it's ownership of that asset, and then how you recognize ownership / control of the useful life of that asset, right? And how you control
Correct.
it over time. And our idea of you buy a car, a Volkswagen, and I can either choose to buy that car or I can choose to lease that car. And it's a very similar context in terms of how you treat that asset. And I think it's an interesting point that you distinguished, and maybe you can share that with the audience around the idea of how you're taking care of and managing that asset, distinguished from if I lease a car, how I treat it and what's going on. I think it's a great point.
Yes. So if we think about it from a simple perspective of leasing a car, when I go to the dealership and I say I want to lease a car, from Volvo or Volkswagen, basically what happens is that car, if I have a lease with, I sign a 3-year lease, I pay $200 a month for that vehicle stays on Volvo's books. It is not removed. Volvo continues to depreciate that as its leased out asset. I, on the other hand, as a lessee, I'm paying Volvo $200 a month for the next 3 years. And then Volvo, as the lessor of this, will recognize lease income or lease revenue from that leased vehicle. On the other hand, if I go to Volvo and I say, I want to buy this asset, and basically we determine that it's a sales type financing lease, essentially what's going to happen is Volvo is going to de-recognize the asset because essentially Volvo is selling the vehicle to me, and essentially I own that asset. I own the asset as the buyer, and Volvo, on the other hand, is going to essentially create a receivable on day one, sell the asset to me. So I have a revenue transaction, and then in lieu of having the asset on my books, Volvo creates this long-term receivable in the leased asset, and then every month they're going to recognize interest income, not revenue, because if you think about it, we recognize revenue on day one for a finance lease when we sold the asset to the lessee. So they're basically going to recognize interest income over the life of that lease. It's a little complex accounting, John, but I think you get the gist of it, right?
Absolutely, absolutely. And the interesting thing is when you and I started talking with several companies that we've dealt with, the light bulb for you and I went off on a couple of different areas, and I'd like to explore this for a minute because it's, as you pointed out, this is a contract that occurs over time. And you and I, who've been dealing with revenue accounting now for 6-7 years, immediately our light bulbs go off and say, oh my God, RevRec. So talk a little bit about a couple of things around the RevRec implications, particularly as it relates to these 4 areas that you've mentioned here.
Yeah, so I think we spoke about this, John, and I basically, from my point of view, it's very simple. Every lessor has to go through the 5-step model. So that's, to me, that is the big so what, and that's the connection between ASC 606 and 842. Because if I'm a lessor of equipment or tool or what have you, essentially I must go through the 5-step model. I have to determine whether I have a contract. I have to determine what's my performance obligations. I have to determine what's my transaction price. I have to determine how am I going to allocate that transaction price over those performance obligations. And lastly, I recognize revenue. So if you think about it from a lessor perspective, that company is going to have to go through the 5-step model like I just went through. They're going to have to deal with what's the performance obligation? What's the performance obligation? We know a lot of companies, especially in the biotech space, what they do is they have these instruments or tools that they lease out, and then they have the consumable portion. So in that aspect, even though they're a lessor type accounting scenario, they are considering what's the performance obligation? Am I leasing the tool? Am I selling the tool? How am I recognizing revenue from the consumable piece? So that turns us into what is the contract combination? Am I leasing out 15 different tools at the same time? I have to combine that contract. Is it the same lessee? Is it the same hospital? Is it the same facility? And then again, we talk about performance obligations. What is the performance obligation? Is it one combined tool and consumable? Is it separate? What about installation? Is that a separate performance obligation? And then the last 2 is really and then this is the most important piece from my perspective, is what is the SSP? A lot of these scenarios we hear in lessor scenarios, a lot of companies go out and give these tools or pieces of equipment for free, and they recognize or they gain revenue from actually they having to buy the consumable that goes in the company's tools. That's when they recognize revenue. However, We know under 606 and IFRS 15, there's no more free tools or free instruments. I have to, by law or by rule, allocate part of my transaction price to that free tool in the customer's mind. Nothing is free under 606 anymore. And then lastly, John, when we talk about from a lessor perspective, we're going to recognize revenue or we're going to recognize interest income. That means that we're talking about, is it a finance lease or is it an operating lease?
Right.
John, I know you have some thoughts on these scenarios because we have done quite a few.
Yeah, no, exactly, Julio, and the light bulb goes off on all of these, right? It's all of the questions and all of the challenges that we've seen over almost a decade of revenue recognition work, which is, you rightfully, of course, contract combinations, contract modifications, particularly as it relates to, when we used to talk about RevRec, we talked about portfolios, right? Particularly for companies that were doing embedded leases or implied leases for equipment, right? I have an outsourced model, and so there's an implied lease in that process, and that becomes the flip side of that for lessors process, and you have this portfolio of leases. So how do you add, subtract, how do you change that? But what was fascinating to me, and we'll show some of this in a moment in the demo, was how do you value, and maybe you can talk for a minute about that, when you're giving away the piece of equipment, you have this income, and we've seen, particularly in the medical device field, but also in software, in other areas. We had a fascinating conversation the other day, I think, Julio, with a company that does concrete, and they do monitoring devices for concrete trucks to maintain the liquidity, if you will, or maintain the proper viscosity of the concrete. But what was fascinating to me is their model is more of we give you the device, but we charge you for access to the information that the device creates through a portal, but also we charge you for the chemicals that go with that device that help do that viscosity and maintain the right chemical balances of the concrete. And so we see these things. But what was interesting to me is, how do you determine the value of the device as it relates to the bundle that you've just sold? Because really you've just created a de facto multi-element arrangement. So it's that flow that was interesting to me, and how standalone selling price and the allocation are so important to understanding the underlying accounting. And maybe you can comment about that. And I know Shirish hopefully was able to join us. I saw him join us a moment. Can talk about that from his perspective as well, and then we'll dive into some of the scenarios in a minute.
Yeah, John. So and this is where the accounting, for us accountants, we get really excited, if you want to say it that way, because it becomes very complex. Because when you think about companies selling a deal from a sales perspective, and you say it's free equipment, it's a free tool, or you can use it. It's not really free. So we have to now work backwards and bifurcate and come out with, how do I get an SSP for what I'm essentially charging as a free tool? Am I going to use my historical price? What would a third party sell for this tool or equipment? And then how do you really bifurcate it? How do you say, is it 20% of my transaction price I'm going to allocate to my SSP, or is it 50%? What's the value? So it really becomes a lot of complex accounting for these lessors. So, and that is exactly the tie-in between lessor accounting and ASC 606. It really is one and the same from our perspective.
Yeah. Any thoughts on that, Shirish? Are you there?
Hey guys, can you hear me?
Yes. Welcome.
Oh, okay, perfect. Hey, thank you. I can finally get in. Yeah, I mean, I'm looking at it more from a downstream. So when you're looking at these lessor contracts, once the revenue recognition has happened and the allocations has happened, the information is being passed on to the leasing tool, And that's where we make sure that we use the values for the net present value and the terms of the contract and the price that you would be paying on a per month basis to arrive at a internal rate of return for those contracts. And then it also helps to because within RevRec, that's the one thing that RevRec would not do is the actual billing. And so that's where CLM or the leasing portion steps in and helps drive the actual invoicing to the customers, and then help kind of cement the revenue to make sure that the revenue is being updated based on the payments from the customers.
Perfect. All right. Thank you, Shirish. Maybe you can touch for a moment, and we'll, let's just briefly touch on this because we do have a lot more about disclosures, and we'll be talking about disclosures and obviously in other webinars that we have, but maybe you can just talk about that really quickly.
Yes, very quickly. So, just like the lessees, lessors also have disclosure requirements. We like to focus on the quantitative, which is if you have a finance lease, you have to recognize the selling profit, recognize at the commencement. And then as we talked about earlier, you create this long-term receivable, and from there you actually generate interest income. So therefore, we're going to show that. If you have an operating lease from a lessor perspective, you will show operating lease income, which is the revenue side of an operating lease. And then obviously, if there's variable components, you also have to disclose how are you recognizing that over the life of the contract. And also too, if you have the maturity analysis, which is basically what is the length of the leases and when are they going to be amortized and when are they going to end. So you have a 5-year table of this is the outlook of the portfolio of lessor finance leases I have from that lease receivable creation.
Cool. Well, thank you. All right, so maybe you and Sarah can touch on kind of the flow. Obviously, we've talked about the fact that SAP provides an integrated solution through RAR and CLM to help customers with either one of these two lease scenarios, whether it's a finance lease or an operating lease, previously known, I guess, as sales leases and capital leases. Talk about that for a moment.
Yeah, so we finished talking about process. Now let's talk about systems from a SAP perspective. So we have RAR, which is the revenue and reporting tool, and we have contract lease management, which is the lease tool, and then we have obviously your general ledger, where all the information from these wonderful tools go into. So our COEs came up with a process flow, one of two models, which is what you see on the screen here. Usually what we found from our experiences is you're going to have a contract tool like a salesforce.com where the folks, the salespeople are entering the contracts. So, from our perspective, it starts with some sort of CRM, some sort of tool that, where you enter your sales contracts and you can document what are the type of contracts you are going into. And then from that, we talked about it starts from a lessor perspective, it starts with the revenue process. So it has to pass through RAR to understand, go through the 5-step model. Is it a revenue contract? What is the performance obligation? What's the transaction price? What is the SSP? How are we going to allocate that SSP? And as what Shirish just said is, once you conclude on the performance obligation, the SSP side of it, and you allocate these performance obligations, if it is in fact a lessor transaction and you have a finance lease or you have an operating lease, there is where it would go into CLM, contract and lease management, and we will have the respective accounting entries. If it's an operating lease, you're going to have an amortization schedule where you're going to recognize operating lease income. And if it's a finance lease, you're going to have this long-term lease receivable and the amortization schedule highlighting the interest income. Outside of these two tools, you will, if there's a finance lease, as we talked about, you're going to recognize the revenue recognition, the sales and cost of goods sold from the finance lease, which is the derecognition of the asset from your books on that day one finance lease commencement transaction, and that also goes into your general ledger. So that is from the accounting perspective. I don't know, Sharish wanted to add some?
No, I think that's perfectly the process that, as you described, Julio. I think when we actually get to the demo, you would also see, the difference between how the treatment varies between the operating versus the sale type of leases. Where in one case, the asset is written off the books from the get-go for the sale type of lease. Where in the other case, there is a direct maintenance of the asset for the life of the lease. And it gets depreciated, and then you can see the various amortization flows in each case.
Absolutely. Well, speaking of demos, why don't we get into the meat of this, and I'm sure what folks would love to see, which is Julio and Sharish and Sarah. Why don't you talk about our scenario? So scenario one is the lessor classifies the scenario as we have an operating lease. Let's talk about that and tee that up.
Yes, I'll just do it very quickly, and then Sarah will take over with the beautiful demo she's about to show you guys. This is an operating lease from a lessor perspective. In this scenario, so we know there's 4 different criteria to determine whether it's a finance or an operating lease. We just made it very simple. We just said the lessor is going to retain the ownership of the tool or the instrument. So we've classified this as an operating lease. What we really wanted to show here is, what does the system look like for a lessor perspective of an operating lease? So in this scenario, we've already entered our information, our contract into RAR. RAR has come up with the appropriate performance obligation, the appropriate SSP calculations. And now we've said we have an operating lease and we need to set up an amortization schedule based on that. Sarah?
All right, well, let's turn it over to Sarah. There you go, Sarah.
Thank you, John. Let me know if you can see my screen.
I can.
Perfect. All right, so when we get into an operating lease, one of the big things that Julio and Sharish and John have been talking about is kind of having one place to kind of handle all of your leases. So this tool is both for the lessor and lessee side, so being able to handle both of those here. We can actually see that we have a lease out contract with our customer. So if we first come in, this is just going to be kind of a quick, fast entry page. We've got a contract lease. This just tells us what it is. As you start to scroll down, you'll be able to see just kind of some quick facts. So the first piece is being who's our partner, or who's the customer that's actually lending, that we're actually lending the asset to, and then it's going to be able to give us our asset information here. We've also got contract information, so for the overall lease, what is the start and end date of the contract, and then are there any notices? So for example, let us know when a contract is coming up to term, so we can either contract the customer and see if they want to renew or maybe purchase the asset after leasing it, and then any other contract information. What's great about this tool and the fact that it actually resides within SAP, it resides within the finance suite, is that it's got direct integration into asset accounting. So I can actually drill back into the asset and actually see where that asset resides. So for example, if I come into our objects, we can see here we've got our object ID, and this will actually take us into our Asset Explorer. So we can see the depreciation of the asset. We can see when we acquired, or the acquisition of the overall asset, what the prices were, the taxes, the titles, when we retired the asset, if we ended up selling it to the customer, or what the overall asset accounting was for this particular asset. We can also see here, we can drill back into the other areas. So it's always going to tie into your leasing contracts. So you can drill back to the contracts, you can drill into the GL accounts, what cost centers we're actually tying this to, and then you can have the different types of depreciation. And that's with direct integration between the leasing tool and asset accounting. Some of the other key areas that we're able to actually bring in is, for example, if customers wanted to renew on their contracts, you're able to actually bring in the option to renew. You can see the overall terms in months, but being able to actually give notifications to the lenders. So being able to say for particular contracts, if you've got 6 months before this particular contract, for example, I think we're working with motorcycles is up, maybe we have our sales team actually go out and try to see if they want to sell the object, the asset to the customer, or for example, maybe they want to try to get them to lease a new asset that we have. So you've got the options to be able to bring all of that in. Here we'll be able to see the actual conditions. So when Julio was talking about tying it back to revenue accounting, we'll have those monthly fees from the customer. So we'll be able to see, we can bring in validity dates. So for example, if we've got a down payment, if we've got a base rent, the acquisition fee, the overall income that's paid every month, you've got sales tax, you can bring in all the different condition types into this particular area. It can break them down by month, it can break them down by day, and then you've got the ability to actually look into the details. So for example, if I wanted to drill into one of these different areas, we'd actually be able to see into the conditions and actually look at the overall details. So what are the validity dates? So for example, if you've got discounts for certain periods, or you've got step rent that you wanted to include, all of those can actually be brought into the lease to be able to handle those here. The last piece I just wanted to kind of go over with everyone is the ability to kind of come through some of the overview documents. So we can come in, we can see the different overviews here. If we wanted to drill into different areas like the account sheets, you'd be able to come in and see different accounting documents that were actually posted. If anything was posted, we'd be able to see. These items are all still open if we wanted to go in and take a look at them. And it's going to drill back into our contract. So this is going to give us all of the different costing, lease accounting costing that is actually there. But the original document that was posted for the acquisition of the assets, and then all the postings per month are all going to tie back into the contract here, and then those will actually get brought in with the RAR contracts as well. So Julio or Sharish, does anyone want to add anything on these operating leases?
No, the one thing I just wanted to add also was from here, you can also see the customer's obligations. So you should be able to see what are the outstanding payments that you would require from a customer. And if you wanted to hook it up to a collections module, you could do that and be able to see on a month-by-month basis where exactly which customer is missing what payments. And so there's a big tie-up there. And so, so there's this whole end-to-end process where, you're starting from an upstream system that is a CRM system that kind of links to an RAR where we're doing all the performance obligations and the allocations. And then that kind of feeds directly into a CLM system where we're actually doing all of the accounting and the amortization. And then here also you're able to see, since it basically feeds to your accounts receivable, you're able to see firsthand, what the accounts receivable looks like for each customer. And then from there, you could proceed directly to your collections if depending on the payments, the frequency of the payments, depending on if there are delayed payments, if there's delinquency, all of that can happen directly in that. So there's a whole end-to-end process that's happening directly all within SAP.
And Sarah, this is John. From the perspective of all of these items that are on here, of course, we have all the different condition types and the different elements. But in the RAR world, we may only get an invoice that has one or two specific line items and may have a linked POB or a bomb that explodes into these other items. And that's where the new reallocation comes from in RAR that then feeds into this piece. Is that correct?
Yes, awesome. That's a perfect way to put it, John. Yep.
Yeah, so anytime there is a modification that comes through from RAR, again, the interface helps us ensure that the modification is passed on. You can do the recalculation of your revalidation and reassessment to make sure if there's any amounts, any true-ups, that also would be taken care of by the tool.
Perfect. All right. So let's take a look at scenario number 2.
Yep.
All right. So scenario number 2, Julio, is the finance lease. So let's
Yeah.
talk a little bit about that one.
Yes, John, I was just so excited to see Sarah do a fully end-to-end lessor scenario in CLM. It's beautiful. And I think one thing I wanted to add was what Cherie said is very important, because it just doesn't end with the accounting. You can have it invoice your customers for you. It goes, you could tie it up to your collection system as well. So it really is end-to-end, and I think that one was really impressive. Anyway, let's talk about finance lease. So this finance lease, we have decided that the lessor does not retain ownership. So if you've been listening a little bit in the last 35 minutes, you would realize that in this scenario, there's 2 transactions. The first transaction is because we don't retain ownership, we will effectively sell this tool or instrument on the commencement day of the finance lease. That's the first transaction. So we would have done that because we would have already passed this contract through the RAR module and recognized a transaction, an event-based transaction, an event-based, a point-in-time transaction. That's the first step. The second step now is what goes into CLM. CLM, as Sharish correctly said, the first thing you're going to do is, most companies want to know, if I sell this tool to this customer under Lessor Accounting rules, what's going to be my IBR, my rate of return, my IRR, sorry. So basically, you can say, if I sell this tool, it's going to give me a calculation of, this is the rate of return on this asset. And then secondly, what CLM will do is set up that amortization schedule. The amortization schedule where we said to ourselves, we're going to have this interest, this receivable, this long-term receivable, because we have now removed the asset from our books and we've debited our interest receivable, long-term receivable from this finance lease. And then every month, we're going to see in the P&L interest income. So with that, I'll turn it over to Sarah, and she's going to show you the integration of SAP.
There you go, Sarah.
Thank you, Julio. Thank you, John. Okay, so we're back with another contract. Now we're looking at a finance contract. So if we come in, everything is still kind of the same setup. We'll be able to come in and see, again, we're working with a motorcycle. So we're leasing a motorcycle out to a customer. Although on this one, like Julio was saying, we can add in different values for what gets brought in. So once we have the net present value and we're able to calculate what that cost is that we're going to be charging the customer every month, with the base rent, we can bring in changes to that cost. So for example, let's say a customer sign up for a certain year. If they extended a year, they got a discount. So they kept the lease after the first year. So they're actually getting a discount down, $300. What that does, when Julio was talking about the IRR, is we actually have the initial IRR value calculated. So when we get that equipment fair value, so that $120,000 that gets brought in from RAR, we've got our start and end date, we've got our monthly amounts. The system actually automatically calculates the initial IRR for you. So it's going to come down. We'll be able to see we've got our calculated IRR rates. Once we make changes to that initial clearing amount or that posted payment amount monthly, you'll notice that the IRR does a new calculation. It's always going to keep our initial value up here, but as any changes get made within the system's going to automatically calculate that interest for that new IRR. So for the rest of the contract, we'll be able to see that new IRR value there. So for example, when we're doing our valuation, or we're able to see our cash flow for this particular contract, let's start with cash flow and then we'll come into postings. We're actually going to be able to see that here. So we have values that have already been posted that we can drill back into. So any of these bolded or underlined values actually have a posting that we can drill back into. So we initially posted that 120,000 for our asset, and then we've got the clearing amounts every month along with our IRR. And as that IRR gets adjusted, you'll be able to see that here as well. Now for those postings, we can actually see those different postings that get made here. So we've got the accounting document, the document number, so we can drill back in. So if we wanted to drill into the initial asset posting, it's going to take us to the accounting document, the real estate documents. We can actually drill all the way back into the original financial documents. So these are actually going to tie back into the revenue accounting items as well. So that initial rental agreement that we have with the 120,000 for the asset, and then all the other postings that get tied here. So there's always drill back capabilities, and there's a connection between the revenue accounting and the lease with the different payments that get posted every month, and then the initial values that get brought in from RAR. And then the interest is also the interest earned that we actually get to calculate. That's important for RAR because we've got the IRR value, sorry, with the 3-letter acronyms, the IRR that gets brought in, so we can actually see the different interest postings and clearing postings as well with the different accounting documents. So we actually have to see the interest income that we are earning on that particular asset.
Hey, Sarah, if I could just jump in here and just show the audience. So this debit and credit is very important because we've been talking about setting up the lease receivable on your balance sheet. That debit there of the 40 to the lease receivable, that is basically going to be your receivable entry, and then you're going to recognize the interest income in your P&L. So that's going to be very important as you have a finance lease on your books, Sarah.
Yeah, thanks, Julio. That really wraps us up for what I wanted to show on the finance lease. I don't know if you guys got a couple minutes here if you wanted to touch Sharish or John on anything in addition to kind of what we've seen here.
No, I think similarly, it's just the same, the same idea, which is, and you highlighted it early on, which is the values that are coming in here and because of the nature of some of these. So in some cases, it's a very straightforward transaction, right? In which we have an item. A motorcycle is probably a pretty straightforward item. I'm leasing that motorcycle out, or I'm leasing an asset out, and it's an asset and an interest income. Maybe Julio, you can talk for a moment while we're looking at this about some of the scenarios we've encountered where consumables are part of that equation, and they are basically, as you said, giving away a piece of equipment to the customer, but they're using consumables and how that might affect and where that comes in from RAR and feeds this aspect.
Yes, John. So it's a good question, and this is why, at least from an accountant's perspective, I like the tie-in between RAR and CLM, because what CLM will do is what you see on the screen here is it's going to create that amortization schedule. It's going to do the math for you. So it's going to basically credit your interest income, credit your receivable, and debit your cash coming in for that every month lease payment. However, on the consumable piece will be handled in RAR, because if you think about what the consumable piece is, it's going to be, I give you an X amount of product, and then I recognize that sale of that product. So it's going to be, in these complex scenarios where you have the equipment, you have the consumable portion of the equipment, you can see yourself having a revenue transaction every month to say, okay, they've used X number of tons or X number of usage. From that perspective, you have to recognize revenue on a transaction basis. So I'm gonna take X number of tons times the standalone selling price of that, recognize that revenue. So I think this really shows the tie-in between RAR, CLM, and then having within the SAP ecosphere an all-in-one solution for all your lessor accounting needs.
Right. And Sarah, maybe if you go back to that screen where you showed the differences in the IRRs for a moment, we'll use that as a talking point, and then we'll wrap up in a moment. And Julio, you hit the nail on the head here, and part of this is all about the variability of the new solutions-based economy, and whether you're talking about an instrument such as a testing device and you're selling consumable products that go with it, whether it's reagents or test elements, or if you're selling telecommunications equipment or you're leasing telecom equipment like a microwave modem, multiplexer, a microwave tower, or you're leasing space, you may lease it but charge only based on the volume of data that people pump through the system, and therefore it has that similar relationship. So don't think of it in simply the context of I have an item and I sell consumables, you know, like the Gillette shaving model where I sell a razor and the blades are really where I make the money, or a printer. You know, there are lots of different areas where these consumable quote unquote models take place, and it can be complicated. And as the customer either uses more or less of the consumables, or uses, needs to do some kind of a forecast true up, that element that's happening in revenue accounting now gets fed into CLM so that you now have the accurate accounting of how much is about the device and how much is your true interest income, right?
Exactly, John. I think that is the integration that we talk about from in the SAP landscape. I mean, I'm aging myself, but I remember when we used to, lease cell phones back in the early days. So, I'm assuming at that point there was serious allocation between the cell phone and the usage of your minutes. So all these things, it's complex accounting. But the good thing about it is that these tools, when used in tandem, will help you solve this for the solution.
Sure, absolutely. So with that, we have only a couple minutes left, so I'm going to wrap up for everybody. And I want to thank my presenters. So thank you, Sharish, Sarah, as always, awesome demo. Julio, the color commentary and the ability to add, just great insights. Thank you so much for that. I want to wrap up and I want to say, leasing continues to be a relevant topic, particularly as we look at the solution economy as something we walk away with. We can see there are different models and different ways that people execute against that strategy. And so it remains relevant whether you are a telecommunications company, a medical device company, an equipment maker. We've seen lots of, and we can hear lots of examples. ASC 842 had huge impacts on lessee, moderate impacts on lessor, but I think to Julio's point, the definition and the understanding of the difference between these two types of leases is where it's crucial to understand what that means. And we had our finance and our operating leases and saw the aspects of that around the difference between the two being who maintains control of that asset, and of course the implications of that over time. Lessor accounting is equally a revenue accounting or a RevRec challenge as it is a leasing accounting challenge. And we need to understand as an organization, and of course, Bramasol brings expertise in both of those to you to help understand that perspective. And you can see how getting the revenue accounting right feeds into the proper interest allocations and the amortizations that are required to do the lessor accounting. And of course, SAP CLM can handle both of these elements, whether you have a finance or an operating lease, but it also handles lessee and lessor lease management. What you saw and what you were able to glean from this was not customization. It was using the tools that are available in SAP CLM as it exists today. Bramasol, certainly we continue to add a lot of aspects and value add to that process. And so, there's a lot to that. We are not, this is again standard activity. Are we using some integration tools and some bodies and boppies to drive some of that integration? Yeah, but it's a pretty standard process that, not standard, It's proprietary smarts that we have developed because of our expertise in both of these, bringing both of these products together. And it's this integration between revenue accounting and leasing that's key to success. So again, this is a great topic. We will continue to explore this topic. I want to thank everybody for your attention. Remember that Bramasol is the leader in business and finance transformation and compliance for SAP. We focus today on leasing, but Bramasol we are experts on order to cash and revenue recognition. Look for our videos and webinars and expertise in treasury, including all of cash management, risk, and other areas. And of course, we've talked a lot about the procure to pay process here. And we do a lot of other aspects of areas as well, including finance operations with accounting advisory. You've heard from one of our experts, Julio de la Costa, today. As we evolve in the BRIM space, we'll be doing more in the solution economy and technology platforms. So I want to thank everybody, and a reminder, of course, we are owned and continue to be owned by Hasso-Plattner. So thank you, everybody. I hope you have a terrific day. Thank you for joining us. Join us for our next webinar. It's going to be happening on December 17th, and we'll be focused in on some great topics that I think you can take away from that. And we'll expect to hear from Julio and the team on that. So thanks, everybody. And please stay safe, stay well, enjoy the upcoming holidays for you here in the US, and we look forward to seeing you on our next webinar. Make it a great day.